Good morning, everybody. Thank you for joining. My name's Tom Adcock. I'm a tax partner here at Gravita. I work here with Tim and loads of other people. So thank you for joining. Today, Tim is going to take us through some capital gains tax refresher and planning. And of course, in light of the recent budget, all the more important. And I'm sure Tim is going to cover many of the issues that arose from that. So enjoy. And if you have any questions that follow the seminar on capital gains tax or anything else for that matter, please do reach out to us and we'll see what we can do to help you. So Tim, good morning and welcome and thank you as always.
Thank you very much, Tom. Good morning. Right. Hello, everyone. Good morning. Welcome to today's webinar. I'm Tim Palmer. I lecture around the UK. I wasn't yesterday. I was meant to be in Aberdeen yesterday, but it was too treacherous to get there. So I did it by webinar instead. And I think it even went better, actually. But it is tough weather-wise all over the place at the moment. Yeah, I do lecture all over the UK. And when I'm not lecturing or presenting webinars, I'm a tax consultant with Gravita, which I thoroughly enjoy and I'm really pleased and proud to do. It's a great firm. So this is going to be a very practical session today, lots to cover. I trust you've all got a set of notes. I do understand that some people joined a bit late. Justine will sort you out if you haven't got a set of notes, but you do need them to have a look at everything that I'm doing. I mean, I've been doing webinars heavily since COVID in 2020, March 2020, dreadful time. But I really have increased the webinars that I do. I think I do 2 every week, 2 or 3 every single week, for everyone. And so what I do, I base my webinars on my notes. So you want the notes in front of you, okay? And Justine will sort you out if you haven't got them. I'm sure you have. And you want to mark up the notes with my extra comments. Now, as Tom said, if you've got any questions or you need tax consultancy or you think, gosh, Tim mentioned this is a good idea, can we know more? There's the email address you want to contact after the webinar, hello@gravita.com. So as Tom says, if you need any tax consultancy, if you want to contact us, if you've got any queries on anything I'm saying, you just want to jot down that email address, hello@gravita.com, and you can contact us after the webinar. Right, okay, lots to get through in the hour. We're going to finish at 10 o'clock sharp today, maybe just before. I know you've got all busy times. It's tax return season as well. Tell me about that. So we're going to start now. And if you go to the notes and go to page 2 of your notes, the capital gains tax rates have been increased in the budget, as Tom said. And really, can I be brutally honest with you? And I'm going to be brutally honest with you the whole way through this webinar. I was delighted. You know, I just thought I was really worried before the budget that she would add on capital gains and make it the top tranche above income. And I saw several articles worrying about that. And we thought, wow, could there be 45% CGT rate for high rate taxpayers? But that didn't happen. And so all you want to jot down and circle the notes on page 2 is that if you're a basic rate taxpayer, and you've got to remember, and I'll give you a little example on this in a minute, you've got to remember that capital gains tax is very much linked, the rates of capital gains tax, to your income tax position and the rates of income tax that you pay. So if you're a basic rate taxpayer from 30th of October, you pay 18%. And if you're a high rate taxpayer on your capital gains after the CGT exemption, you pay 24%. And I've got to be honest with you, I'm delighted that those rates are as they are now. I thought they could be and would be after the budget quite a bit higher, and they weren't. So it's just basically 2 rates. Basic rate taxpayer, 18% CGT, 24% taxpayer, high rate taxpayer, 24%. So 18 basic, 24 higher. And I think many tax commentators are quite happy about that. The main rate of CGT was increased that CGT rates were increased on midnight of 29th of October, even though we were not aware of this till the budget speak 1 p.m. the following day. And the increases are not as big as many commentators feared they would be. Right. Yeah, I'm a bit disappointed about this. I mean, a few years ago, only a couple of years ago, the CGT exemption was 12,300 per person, over 24,000 a couple. And we got used to clients doing deals on the stock market, identifying maybe AIM shares that they thought were cheap. And they did well if they did their homework and researched. And then they would make gains up to £12,000 for the husband, £12,000 for the wife, exempt from CGT, 24,000 a couple, married couple. We got used to that. But now the CGT exemption is only 3,000. That is disappointing. I think it should be higher. And that's 6,000 a couple. It's going to be frozen at £3,000 for the next tax year, 25-26. This is good news. I was surprised. We're surprised that the capital gains tax-free uplift on death was retained in the budget. So it has been retained. You just want to, that's an extra point, not in the notes. You want to note this, but that's good. A lot of this CGT items following the budget gives you a chance to do good planning in this area, which we're going to go through heavily throughout this 1 hour session. But capital gains tax rates are very much linked to income tax rates. And let's just do a quick example on page 2 at the bottom. Brian's a carpet salesman, self-employed. He'll be delighted with a very low level of national insurance that he's paying now, that was kept 6% NIC for him. Right, he's a carpet salesman, and his profit after deducting the personal allowance is 30,700. Right, the first thing to remember is his basic rate band for 24-25 is 37,700. So if he makes gains above the CGT exemption, the first 7,000 will be taxable at the lower rate of CGT, and then the remainder of the gains will be taxed at the higher rate. What's his gains? 38,000. Knock off the CGT exemption 3, you're left with a chargeable gain of 35. Right, straight away, you can say, well, that gain is linked, the rates, to his level of income. And because his income is only 30,700, he's got 7,000 of those 35,000 gains taxed at 18%. And the balance of the 35,000, which is 28, will be taxed at 24. And it's the same with Scottish taxpayers. Scottish taxpayers, I do a lot, lectures in Scotland. We have clients in Scotland. I have a relative in Scotland. So Scottish taxpayers use the English income tax rates and bands and thresholds to determine their CGT as well. So that's how it all works on a basic level. Just have a very quick look, page 3. Let's have a quick look at a capital gain taken from one of our clients a couple of years ago, and we've updated it. Bobby, go to the top of page 3. Bobby is a bachelor. As I've said before, you don't often hear that term anymore, do you? I think I told you previously, there was a pop group called the Bachelors in Ireland. I think one of them was called Declan. Anyway, Bobby, this bachelor, single guy, he buys a lovely house in Amersham in Buckinghamshire, and he bought it for £400,000. Right, okay, and he lives there as a single guy for 3 years. Then he meets this girl, falls in love with her, but this is a tax lecture today. He falls in love with her, and he moves out and moves in with her, and then he rents the property after 3 years of living there. All right? And then eventually he sells it. Now, he won't be aware probably, but he's walked into a capital gains tax minefield because he sold it, and some of the gain will be exempt based on the years he lived there and the last 9 months. But a large part of that gain is going to be chargeable because when he owned the property, for the latter part, he rented it out. So how much is the gain? £850,000. The cost is 400, so he's got a gain of 450. How much of that 450 gain is going to be tax-free? 3 years he lived there, plus the last 9 months, that's 45, over 75 months total ownership. So the gain that's going to be tax-free is £270,000. Right, okay. So chargeable gain 180. You don't get lettings relief anymore normally for clients now. They changed the rules on the 40,000 lettings exemption. And to get lettings relief, you've got to live in the property with your tenant. You've got to be Rigsby. Well, every time I mention Rigsby, I mentioned it yesterday, people didn't seem to know who Rigsby was. Google it, Lenore Rossiter, marvelous program. So you've got to be Rigsby. You've got to live in the property with your tenants, and the landlords don't do that, so they don't get the 40,000 anymore. And then they only get the very low 3,000 CGT exemption. So this poor guy, Bobby, he's got £177,000 capital gain. He pays 24% CGT on it now, high rate taxpayer, and he's got 42,000 odd CGT to pay, which is a nasty shock to him. And he's got to pay it within 60 days from the date he completes the sale of the property during the tax year, which is the landlord's tax regime for capital gains tax that we'll come on to later. Do you know, can I be brutally honest with you yet again? And can I say, clients struggle to remember to tell the accountant during the tax year that they've sold a property that they've rented. You know, even now we're seeing that clients and tax consultancy clients in particular, they don't always tell the accountant as they should do as soon as they've sold a property. You've got to get your clients into the habit, the landlords, of thinking, right, I've sold this property, I need to tell the accountant, because you've got to do a capital gains tax return within 60 days of completion and pay the CGT. And the revenue, right, in the first few years of this, going back a few years, they were very lenient with the penalties. They're not now. They're charging the penalties now if you file a CGT in-year return late, and there's very little you can do to get out of them. Right, let's go back to the budget for a moment. Okay, now I was worried before the autumn budget that business asset disposal relief would be scrapped altogether, but it wasn't. So that's good news. It wasn't scrapped in the autumn budget, and they've kept the lifetime allowance at £1 million, more on that in a minute. But the one thing they did change in the budget on business asset disposal relief, formerly called entrepreneurs relief, the one thing they did change was that they've said that if you sell your business after 5th of April next year, you'll pay 14% CGT. And if you sell your business after the 6th of April 2026 and you qualify for business asset disposal relief, you'll pay 18%. And you want to write in, I think those rates will go up even higher after the 6th of April 2026. So it's interesting, and I think we'll have a few people at Gravita, a few of our clients, and I'm sure other accountants will have as well, where they're thinking of selling a business. They'll be keen to sell it before the 6th of April next year to have the capital gain chargeable at 10% rather than 14%, up to £1 million. Right, let's just reflect for a moment. Go to page 4. Can we reflect for a moment on business asset disposal relief? Go to page 4, and you might want to highlight some of the comments that I've made on the notes. Now, prior to the March 2020 budget, you had a 10 million lifetime limit, very generous. And clients would sell businesses for 7 million, pay the CGT at 10%. They'd have 3 million of their lifetime CGT entrepreneurs relief allowance left, and they were pretty happy about life. And then we heard a rumor in February 2020 that the Chancellor was thinking of reducing the lifetime allowance. You know, these rumors are all on the internet, you do hear them. And so, you know, people then started selling businesses, perhaps preempting the change, and the change did come in. When Rishi Sunak became Chancellor, first time many people in March 2020 had ever seen him, he suddenly announced, bang, from now, entrepreneurs relief is going to be reduced, the lifetime limit, from 10 million to 1 million immediately. And that was the first big thing that he did. I remember it so clearly at the time of COVID, really, as well. COVID was just starting when he had that budget in March 2020. So that was a huge drop in the lifetime allowance for capital gains tax from 10 million to 1 million, which has remained following the budget. But remember, if somebody wants to get business asset disposal relief, because Rishi changed the name from entrepreneurs relief in March 2020 to business asset disposal relief, if you want to get that 10% current rate, you've got to have owned the business for 2 years. You might want to circle that on page 4. We get whiz kids contacting us at Gravita, and they say to us, we've done this amazing business, we formed it quickly, and we've had an offer, but we'll only pay 10% CGT. They won't. They're probably going to pay now 24%, because that's the rate for high rate taxpayers. Why? They haven't had the business for 2 years. So you really got to make sure that your clients do own those business for 2 years. And as I say, on the bottom of page 4, I think that people who are thinking of selling their business will definitely do so before the 5th of April, by the 5th of April, to get a 10% rate rather than 14 the next, start the new tax year. Right, turn over to page 5 of your notes. Now, this budget, what did it do? Well, the thing you got to remember is that everybody's talking about the inheritance tax changes in the budget, which I think we're all very familiar with, and I'll remind you of in a moment. But when you do the planning for the inheritance tax changes, inevitably, you've got to do planning, and you have to do capital gains tax planning to enable you to do your inheritance tax planning. Right, let's first of all, can I quickly remind you of the changes, but I'm sure you're all very familiar with them, on inheritance tax in the autumn budget. The government is going to change business property relief for IHT and agricultural property relief from 6th of April 2026. At the moment, now, it's uncapped. So you could leave a business worth 60 million and get 60 million business property relief. It's uncapped at the moment. This is a very generous time. But from the 6th of April 2026, there is a cap being introduced, and the cap is £1 million. So that's a big drop, isn't it, on business property relief? Big cap. And the first 1 million combined of business property relief and agricultural property relief is 100% exempt thanks to the reliefs. And then if you sell a business for more than 1 million, you gift a business I apologise, you gift a business for more than 1 million, the excess is going to be chargeable to IHT at 50%. So this all comes in from 6th of April 2026. So this is a massive, huge change to inheritance tax, huge change. And people keep asking me, what planning are you considering? And we're going to go through it now. And when you do your IHT planning, you've obviously got to consider and build in the capital gains and plan for that as well. So capital gains tax planning is very much linked to IHT planning. And let's just have a look perhaps at the 3 or 4 things that people are currently doing at the moment. Right, the one thing that we're experiencing an awful lot of requests and demands for people saying, can Gravita help them to do this? They're transferring businesses into trusts, farms into trusts, and they're considering doing it now, next year, and before 6th of April 2026. And they're claiming holdover relief and business property relief for IHT. Is this happening? Yeah, it is. I get the Sunday Times every weekend, and in last Sunday Times money section, there was a huge article, I don't know if you saw it, on the farmers and Jeremy Clarkson saying, don't worry, we're going to transfer the farms into trusts. You need to take advice on that, and Michaela Lamb in our IHT team can really help you. It's not just something you can quickly do, but it does need some advice, and we can help you in that area. But in the right circumstances, it's really worth doing. Right, the second one, if you trust your kids. Do you trust your kids? I trust one of mine. I'm not so sure about the other one. But you could transfer the farm and the business to them now. and make your appropriate capital gains tax holdover relief claims. We have had requests for people who want to do that. Okay. Now, the one that people have started to look at, and Gravita can really help you in this because we're very experienced with family investment companies. This is the one. And people are now starting to think, well, perhaps we should use a family investment company for our IHT planning. And they're doing it. We've been doing this for years anyway. So, yeah, this is quite a big tax planning tool. Can I just put up a few extra slides on family investment companies for a minute? If you've got any queries on these, you could contact us. We've got loads of people in our team at Gravita that do an awful lot of advice and help you form these and tell you the best way to do it. But they're very useful tax planning, inheritance tax planning tools. High net worth individuals, which have a big potential estate, they create a family investment company. They're a very effective tax planning tool. And the family investment company is a private investment company that's normally used for family succession planning. And the directors and shareholders are the individual family members stroke trusts. You get it all set up, different classes of shares. The directors will be able to decide who gets the income, who gets the capital. The founders have complete control, if you do it properly, over proceedings. You normally have different classes of shares. From the founders have one class which are voting, etc., etc., to the others. And this gives them really complete control over their wealth and how they want it to be distributed in the future. Yeah, they will keep control over everything. I think the family investment companies are a fantastic tax planning tool. If you want more details on that, you could contact us. And also, as well as forming the company and having the share capital, you could lend funds to the family investment company. This gives you the advantage of being able then eventually to extract the funds without taking a dividend. It's very common to combine equity and debt to finance a family investment company. We'd love to help you with those because we think they're so tax efficient and they can suit a client's planning needs, family investment companies. Right, now the fourth point is one that you definitely want to consider, right? Can you read it? Let's read it together in the notes on page 5. Because the £1 million combined APR and business property relief allowance is not transferable between husband and wife, married couples should ensure that their qualifying assets are not owned by one spouse only. This will ensure that they can both benefit from the £1 million 100% IHT allowance, and on the death of the first spouse, this is the planning bit, at least £1 million of assets should be passed on to trusts and individuals. So the first spouse in their will wants to say, right, I've got a big business, but £1 million worth of this business or the big farm can be passed to put into trust or individuals, and then you're using up your £1 million of agricultural property relief or business property relief. So you want to build that in your will. You're probably going to have to change your will to do that now. But that way you don't waste the £1 million business property relief or agricultural property relief on the death of the first spouse. You don't want to waste it. I think you want to go away and quietly, I'm going to throw a lot at you during this hour, you want to go away and quietly look at that paragraph again. And I don't mind if you then recommend that to your clients or whatever, but they probably will need to change their wills to do it. Right, okay, so I think with these new inheritance tax changes coming in, that really families, members need to discuss things amongst themselves, and then they need to speak to their accountant much earlier, perhaps, than they would normally do, okay? And I think that's critical. But the good news is that you've got until the 5th of April 2026 to do it all. I would start planning and doing it earlier. This is obviously subject to all coming in the legislation, but there's an awful lot of planning that you can do. Make sure on the death of the first spouse you use up he or she uses up the £1 million. You want to consider the use of family investment companies. You also want to consider the use of trusts and transfer possibly the business or the farm into a trust sometime next year. I'll leave you to read all of that. If you've got any queries on anything I've said, contact us at Gravita and we'd be delighted to help you. Right, today's capital gains tax, refresher and planning. And I'll tell you what, this next area, I'm seeing a lot of HMRC attacks. Go to page 6. I've talked about this before, but for example, I was in London a couple of weeks ago lecturing, and a man quietly came up to me and he said, do you know anything about the CGT TAR? And I said, yes, I've written articles on it. I've seen clients, unfortunately, have been attacked on it. We've done tax consultancy work on it. And he said, well, I've got a client who has had a letter from HMRC applying the TAR. Now, perhaps I can ad lib a bit now and just remind you how the TAR works and when you could get caught to it. Right. If you've got a pen, you might want to jot this down. I'm not going to look at the notes for the moment. I'm just going to ad lib because I'm so used to helping people with the TAR and trying to avoid it and then dealing with it if they haven't come to me previously. The TAR is anti-avoidance, capital gains tax legislation. And what a lot of people will do, they will liquidate their company, and the capital distributions that come out at the moment, up to $1 million, they'll only pay 10% CGT on, thanks to Entrepreneurs Relief, now called Business Asset Disposal Relief. In the old days, it was 10 million. And people are happy to do that. They liquidate their company, they get distributions from the liquidator, capital distributions. They claim business asset disposal relief. They only pay 10% CGT, pretty low. They can use up their annual CGT exemptions for what it's worth, and everybody's happy. But the accountant has got to warn them that if they, after they've liquidated, if within 2 years from the date of the last liquidation distribution capital payment, if within 2 years from the last distribution in the liquidation, they start up the same trade again or a similar trade, and the revenue can prove really they're liquidated to avoid income tax, i.e. to take the money out at CGT rate 10% rather than 39.35, the highest dividend rate, the revenue will attack you with the TAR. And if they attack you, they'll go back to the capital, to the distributions in the liquidation, and they'll retax them as income at, almost 40%, as opposed to 10% CGT. So that is the TAR. Basically, the TAR can hit you where you've liquidated, got the money out at very cheap capital gains tax rates, and then you start the same trade up again or a very similar trade within 2 years from the date of the last liquidation distribution payment. I've seen in my career over the last 3-4 years, I've seen a lot of people do that because they're ignorant about the TAR. I'm not being rude, I'm just saying they don't know about the TAR anti-avoidance legislation. Perhaps their accountant hasn't warned them. I think every time a client liquidates, you should warn them about the TAR. And if they start the same business up again within 2 years, they could be attacked. I think you really need a commercial or an exceptional reason why you liquidated. And if you haven't got that, you could be subject to the TAR. The revenue will go back and retax the distributions in the liquidation at much higher income tax rates. That's the effect of the TAR, rather than the CGT rates. So you've got to be very careful. As I say, I spoke to this guy at the lecture last week. In the last 6 months, I've had a few cases where people come up to me not really appreciating the TAR, and they've had letters from HMRC who are applying it. Now, for HMRC to apply the TAR, if you go to page 6, they've got to prove that all 4 conditions apply. All right, bottom of page 6, conditions A, B, C, and D. And HMRC have got to prove that all 4 conditions apply. Right, now we've got so much to cover yet, and time is moving on even now. So can I just say, condition A, just want to write in, the individual's got to have 5% of the company that was liquidated, probably will have, in most cases, that is definitely the case. HMRC win that one. Condition B, company was a close company, it was liquidated, they will be. A and B, normally HMRC win. They person liquidations had 5% and it's a close company. Now, this is where it gets interesting. The individual who's liquidated the company carries on, starts up the same trade again within 2 years from the date of the last capital distribution in the liquidation. Now, you start up the same or a similar trade. We could help you with that if you want examples or got any queries about that. But in general terms, if you start up the same trade again within 2 years from the date of the liquidation distribution, you could be attacked by the TAR. And the thing you got to remember, if you turn over to page 7, the thing you got to remember is you can start up the same trade up again in one of 5 different ways. You might liquidate, get the money out at 10%, and then start the same trade up again as a sole trader. Or you might have incorporated, or you might have formed a partnership, or you might have formed an LLP, or to a lesser extent, you might be an employee of a connected person. So you've got to be very careful with this. It's not just, oh, we liquidate a company and start up another company. You could liquidate the company and start the same trade up again as a sole trader and be caught by the TAR. And I've seen people caught. So you've got to be very careful. You've got to warn your clients about this. But finally, for the HMRC to apply the TAR, they've also got to prove that condition D applies. And that the main purpose, or one of the main purposes of liquidating the company, was to avoid or reduce a charge to income tax. Now, this legislation is very widely drafted, yeah. And I think HMRC will always think, well, they got 5%. It was a close company. They've liquidated, and they then started the same trade up again as a partnership, say, or a company. Why did they liquidate and then start the same trade up again so soon after liquidating? Surely the only reason that they liquidated and started the same trade up again was to get the money out of the company at their very cheap CGT rate to avoid income tax. I'll repeat what I said earlier. To defeat condition D, you might want to write this in, you need a commercial reason why you liquidated or an exceptional reason. And I'll tell you what, to help you, I will give you an example of one a few years ago that I was involved in. We won because it was an exceptional reason, and eventually the revenue accepted it and agreed that the company was not liquidated to avoid income tax. Follow the screen. This is not in the notes, but follow the screen now. Frank and his wife Jill, they had a florist shop. I actually met them. Charming couple. You know when you meet people and they're so nice, and they were Tottenham fans, so that was even better for me. Tottenham at the moment, up and down like a yo-yo. But let's hope now we are stabilising and we are moving on ahead on a consistent basis. But I'll believe it when I see it. Anyway, Frank and his wife Jill, they had a florist shop. I met them. They were charming. And because they were so nice, I was just tempted to buy flowers, which I don't often do, actually, for my wife. I'm bad on that score, but I did. And came out of there feeling happy. They were just such a nice couple. But then tragedy came in, and Jill got cancer. Now, these were clients of another accountant that at the time I was helping. And it was so, so sad. Actually, I'm reading a book at the moment by Chris Hoy, the ex-Olympic cyclist. And it's quite a sad book. It's his biography, but it reminded me of this. And I'll tell you, if you haven't read this book by Chris Hoy, it makes you appreciate life, and perhaps you want to get it. Anyway, Jill got cancer. She became very ill, and her husband liquidated the company, closed the florist shop down to become her full-time carer. And I admit, they got the money out of the company as capital distributions as you would. Tragically, she died. And then he couldn't cope with things. And he decided to fill his day up, that he would start a small florist again as a sole trader. And HMRC didn't know all the background to this, but they did see that he'd had a florist company liquidated. It started up again as a sole trader, and they challenged him with the tar. And we helped the accountant defend the tar, because the main purpose of liquidating was that he could be her carer and to look after her, not to avoid income tax. When they found out all the facts, HMRC agreed that the condition D was not met. He didn't liquidate the company to avoid income tax, and as a result, the tar didn't apply. So I'll say it one last time. You do need to defeat condition D by arguing that you've got a commercial reason why you liquidated, or an exceptional reason like the florist company there. Right, let's move on a shade now, because time is moving on. If we go on to page 9 of your notes, this area, I admit, causes me problems, because this business about you've sold a rental property, you've completed, and you've got to do the CGT return within 60 days and the capital gain within 60 days. It's difficult, because clients are not used to advising their accountants and dealing with returns during the tax year. But you have to get the landlords, au fait with this. You have to get them used to telling the accountant as soon as they've sold a property, rental property in the year. And remember, this also applies to second homes. And you've also got to remember this applies to trusts. If a trust sells a rental property, they've got to do the capital gains tax in year return within 60 days of completion. And this also applies, these are areas that have caused us problems, to executors and personal representatives of an estate. Can I just ad lib a bit on some of the problems I've had with this, and that you might need advice and help with in the future? This is a nasty, nasty area that is difficult to successfully comply with. We've had partnerships changing their profit sharing ratios and their capital asset sharing ratios, and that's triggered a capital gain effectively. Can you believe that's true? It did. What others? Oh yeah, the other thing you got to remember is that if you've got a husband and wife owning a rental property jointly, they each have to do a CGT return, and they each separately have to pay their CGT within 60 days. These are all things that in practice I've had problems with over the last couple of years since it's been brought in. Any others? Yeah, we had one case where the wife paid a different rate of CGT to the husband. So we had to sort all that out. Unbelievable. And the problem we've had on a couple of issues was that we couldn't get the original cost of the property. So you've got to get all that sorted, and you've got to get your clients into the habit, and you've got to be prepared for it, to do the capital gains tax return within 60 days from the date of completion of the sale of the property. I've listed out on page 9, 12 areas, items and points. I'm not going to perhaps go through all of them, but let me just pick out a few. So it started life as a 30-day regime. I actually complained about that in 2020 because I knew somebody connected in this whole area, and we got it. It was then increased a couple of years later, or a year or so later, to 60 days, which it is now, which is good. So you've got to remember, this only applies to residential property, not commercial. And also it doesn't apply to companies, this regime, but they've got ATED and other issues with houses. You only have to pay the CGT and file the return within 60 days if there is CGT payable, in general terms. Right, you've got to open up the account, which is time consuming. The client has got to go through a lot of checks, very laborious time. And remember that if that landlord is a big landlord and he's selling a few rental properties in the year, every time he sells a property, he has to do a CGT return. So this is quite a big issue, quite a big thing. And it does apply to second homes as well, and investment properties. We had a case last year where a client inherited a property that he didn't really want. And he didn't really want it. So what he decided to do was to do it up and then sell it for a big gain, which he did do. But this was investment property. He had to report the gain and pay the CGT within 60 days from the date of completion. So you've got to be extremely careful about this and to really obviously make sure that your clients comply with everything that they should do. Just a few technical things on page 10. You've got to be careful about estimates because they've got to be reasonable. If they're unreasonably low, the revenue will charge you interest. You've got to tick a box to make sure that the revenue know that you've estimated. As I said a minute ago, personal representatives, this can be awkward because technically they can't open up their own, they can't do their own return. You have to get an executor to do it in their name on behalf of the estate. Trusts have to be careful and they've got to comply with it as well. But there is a planning opportunity. Now, if I can stop for a minute, we're on the bottom of page 10. What we do, and you might want to do this, is we send out an email to our landlord clients late January. I know it's a busy time for tax returns, but we do it. And we say to them, if you're going to sell your rental property, maybe in March, let us know. Because if you exchange in March, the gain will be taxable, for example, this year in 24, 25. And then so long as you do the self-assessment tax return within 60 days from the date of completing the sale of the property, you don't need to do the CGT return. And you've got huge cash flow advantages because the capital gains tax will be payable not 60 days later because you haven't needed to do the return. It'll be payable on the normal date, 31st of January, after the end of the tax year that you made the capital gain. We give you an example of this on page 11. So you might want to start this. And can I just say, you might want to consider sending out an email to your clients in February time, early February, and saying, look, if you exchange and sell a rental property in March, let us know immediately. We'll do your tax return for the tax year and we'll get it in within 60 days of you completing the sale. And then we won't need to do the CGT return and you'll have a cash flow advantage regarding the payment of the CGT. Right, let's move on a shade now. And can I just remind you of one issue that is a huge capital gains tax issue currently that we're working on at the moment. If you go to page 11, capital gains tax and furnished holiday lettings. Now you might want to write in on page 11 that from 6th of April next year, furnished holiday lettings activities in general terms is no longer a trade. So this is a huge change. And many accountants and tax advisors all over the UK are currently working on this, as well as doing the tax returns and everything else. And they're saying to the clients, right, you currently let out a lot of furnished holiday lettings properties. You need to do your planning now, because from 6th of April next year, this is no longer a trading activity. And all the wonderful reliefs that you currently get at the moment, you won't get from 6th of April 2025 onwards. Now, this is not in the notes, this next remark, but you might want to write it in. We're getting a lot of landlords who've got furnished holiday lettings properties contact us at the moment, and they're saying, what's the position with our pension payments? Well, you could write in, well, the position is that at the moment, furnished holiday lettings profits are relevant earnings. And you can make a big pension contribution when you work out all the figures, because your furnished holiday lettings profits are relevant earnings. They support and give you the relief for the pension contribution. But that will not be the case from 6th of April onwards next year. So a lot of clients, and you need to reach out with your clients and make sure that if they want to, they pay a pension contribution, probably for the last time, to get the tax relief. And also, I mean, I know a lot of people who've rented out furnished body lettings in Devon, where my mum came from before she died, and Exmouth, Dawlish, Ilfracombe, further south, Torquay, Newquay. They've got all these furnished RD lettings properties, Bournemouth as well, and they're putting in new kitchens in them now to get the capital ounces now at 100%, because they won't get the capital ounces at all for new expenditure after 6th of April. What about the capital gains tax position? Well, this is big as well. If you sell a furnished RD lettings property and you meet the conditions, hopefully, you'll get entrepreneurs relief, which is now 10% on the gain. And we've got clients contacting us at the moment saying, well, we were thinking of selling the furnished RD lettings property. We're going to sell it now to pay tax at 10%, obviously, rather than 24% after the 6th of April. And also, clients are now gifting these furnished RD lettings properties to their children. They're claiming rollover relief. All of this stops on the 6th of April. And perhaps we can give you advice and help you in this area if you need it. Right, let's move on a shade now because time is moving on. We are getting a lot of landlord clients, a lot of accountants contacting Gravita, and they're saying, we're thinking, or the client's thinking, of incorporating the rental property portfolio, which is a complicated and complex task to do. Each incorporation is different. And we always say to the client, well, I don't know if it's worthwhile you incorporating your rental property portfolio. Let's look at it and we'll give you advice as to whether we think you can do it or not tax efficiently. Because the two main areas that can cause huge problems if you've got an individual, he's got 8 properties, rental properties, and he's thinking of putting them in a company, you've got to be very careful about stamp duty problems and capital gains tax problems. So if you're watching as a client and you're thinking of incorporating your rental property portfolio, or you're an accountant thinking of incorporating on behalf for a client, contact us, because this is an issue that we've been advising on for a few years now, and we really know what we can help you with here. We've got to be brutally honest with you. In some cases, it won't be worth doing it. You just can't do it. But contact us, because in a lot of cases you still can, and with the right strategy and planning, you can avoid huge stamp duty and capital gains tax issues and problems. Right, that's something perhaps you can contact us and we'd be delighted to help you about. Right, moving on, part 4 of your notes on page 12. The next big area that I want to talk about now is capital gains tax main residence relief, or principal private residence. People call it different things. We're on page 12 of your notes. Now, I've never known such a time for the revenue to query so frequently capital gains tax main residence relief on the disposal of a home. I think it all kick-started with a case called Mrs. Hashmi versus HMRC back in 2020 COVID time. I remember this case so well. Mrs. Hashmi, this was the case that really slightly embarrassed the revenue because they had gone down the wrong track, if you like. More on that in a minute. But this lady acquired a house each year, did it up and sold it, and got better and better at what she was doing and made quite big capital gains. So she bought and sold 3 properties in 3 tax years in quick succession. She claimed that she lived in them and that the gains were exempt from main residence relief. But as well as all of that, she'd sold 2 other houses, if you go further down page 12, and HMRC claimed that her main residence was 132 Shaggy Calf Lane in Slough. Can I get there in a slide? And they said, well, you've claimed child benefit, you've got loans, and all the time, everything is addressed to this property. We think, HMRC said, we think this is your main residence, and the others are not. We can't see any proof that you lived in these properties. She appealed. She went to the lower tier tribunal. She lost. And I must admit, I've supported HMRC in their conclusions. And the judge concluded that she didn't live in these properties and that gains were chargeable. But then the judge dropped a bombshell. And he said, it's very clear to me that Mrs. Hashmi was trading in property. But he couldn't do anything about it because he was here and had to give the judgment to see if main residence relief for CGT was due. That was his remit, and he said it wasn't. But he actually said in the judgment, it's clear that she's been trading in property. He was implying that HMRC should have charged income tax on the profits, the gains on the properties, not CGT. That was a bit of an embarrassment to HMRC. And as a result of the Hashmi case, they've launched, can I call it a campaign, where if people are buying and selling property frequently, like Mrs. Hashmi did, HMRC will quite frequently argue that the individual is trading in property and that the capital gains are income chargeable at 45% if you're into that bracket, which a lot of these people will be. Again, I've lost track of people coming up to me at lectures and saying to me, Tim, we've had a letter from HMRC on one of our clients. These are other accountants. And they're saying that HMRC have argued that the client's bought a property, did it up, sold it, capital gain, exempt main residence relief, so they've alleged. And then they've done it again and again. Particularly builders do a lot of this. And there are letters flying around from HMRC at the moment, and they've taken cases to the tribunal. I think from memory, there was a case called Mr. Campbell. You might want to check that out, where I thought HMRC were very unlucky to lose that case. They alleged he was trading in property. But the big case on this is Gary Ives. If you go on to page 14, Gary Ives, this case I think is the most amazing case I've ever seen in my tax career. I mean, this guy bought and sold 3 London properties in 5 years. He was a builder. And he bought 2 flats the first time, knocked it into a house, made a huge gain when he sold the property. As soon as he'd done that in 2010, he then moves on to the second one in Wandsworth and then does that, huge gains again. You're talking millions here. And then the third one, very similar. And HMRC argued that he was trading in property and that the gains were chargeable to income as opposed to CGT. And it goes to the tribunal, and he did defend his position very well. He argued that, can we read it? On page 14, he claimed that each property was renovated to become a family home. He lived in each of the properties when he was renovating them. However, his wife only moved in when the properties were habitable, which was a lot later. I must admit, when I was reading the case, I thought, well, I think HMRC stand a very good chance of winning here. They lost. Now, last week, I actually did some research in this case because it just genuinely interests me. And as far as I can see, HMRC have not appealed against this decision, which I find surprising, and the decision stands. But I'm going to predict next year in 2025, you will see further cases in this area. And it will be interesting to see if HMRC do indeed win any. Now, finally, my last area that I want to talk about today is probably one of the most important, the use of employee ownership trusts. Again, I don't think business owners, company owners, use these enough. I was speaking to an accountant recently where they didn't really know about employee ownership trusts, and their client had sold his business to the management team. and he paid capital gains tax. And I said to the accountant, well, why didn't he get the management team to form an employee ownership trust? And then he could have sold the company, which he had a controlling interest in, to the employee ownership trust. And I said, if he'd have done that and met the conditions, the capital gain would have been CGT free. That's the beauty of somebody selling their company to the management team who've formed an employer ownership trust, and you can sell the business, the company, to the EOT, and the capital gain is not chargeable, and it can be a big capital gain, not chargeable at all to CGT. I've set it all out on page 15. Now, we at Gravita, we've had a lot of experience in dealing with EOTs, and we'd be delighted to talk you through how to do it, that you might have clients in this situation which are thinking of selling their company to the workforce. In many cases, it's worth doing it through an EOT. I mean, the advantages, I'm running out of time a bit here now, but just very quickly, the advantages are that the vendor will not have to pay CGT if you can meet all the conditions, which is absolutely brilliant, huge saving. It will be the gain will be exempt from CGT because the way it works out is it's a no gain, no loss disposal, and then the EOT acquires the company shares at the base cost of the vendor. So that is a massive CGT saving for the vendor. And I don't think people use EOT as a tax planning vehicle. They should use EOTs a lot more. We can help you with this. The other benefit is to the workforce, because then the trust is set up for the benefit of the company's employees. They can get bonuses each year up to 3,600 tax-free. They will be chargeable to NIC, but they're tax-free. And then they genuinely feel that they've got a voice in how their business can be run. Now, I've met several companies owned by an EOT. I've actually met the staff. They love it. One of the companies that was sold to an EOT, and I met the employees subsequently after the sale, they'd formed an employee council where the council members looked after the employees, and they said, oh, well, perhaps we can do this for the employees. They make recommendations to the board. It's a marvelous situation for both the vendor and the employees working for the company owned by the EOT. We've got people at Gravita that can really help you with that. And I think it is a marvelous thing to do. And I honestly think a lot of people don't always know about EOTs. And I think it's a vehicle that you should consider if you're thinking about selling your business to the management team. Very tax, particularly CGT, tax efficient. Right, I've reached the end more or less. And so can I have a conclusion here? And bottom page 15, capital gains tax now is a good planning area where at the moment and next year you can do a lot of planning. You've got a window of opportunity. For example, you could transfer businesses into trusts. You could sell your business, as I've just said, via an EOT or to an EOT. You could use family investment companies. You could incorporate your rental property portfolio. But all of those 3 or 4 things that I've just said, you need to be careful with, and you need to take advice on, because there are little nooks and crannies and little areas of tax you'll be very careful about if you're thinking about doing all of that. And at Gravita, we can definitely help you. Right, now, so reflect on that. Go away, have a look at the notes again. Everybody's got different needs, different requirements, different capital gains tax planning, and contact us if you need any assistance in the future. Right, I'm going to finish by just saying thank you very much for watching today. If you've got any queries or you want some more details, reach out to us. We'd be delighted to help you. And finally, can I just remind you of the forthcoming webinars that Gravita, that I think are marvelous to do this, they're putting on for you in the very near future before Christmas and also early in the new year. And I'm just going to select 4. All the details of these are on our website, on Gravita's website. And if you want to join up, you are very welcome to do so. Can I just very quickly go through these 4 and then we will finish? Perhaps the first one is the best one. I know Dion very well, and I'm actually looking forward to watching this. Dion is going to talk about COP9, COP8, alternative dispute resolution, how they can help you. I don't think COP9 will help you, but how he can help you fight them, when they will occur, the consequences are extremely serious. It's interesting, actually, if you get this week's taxation, Dion deals with a reader's query on COP9. If you've got Taxation Magazine towards the back where they have the readers' questions and answers, and Dion gave, I thought, when I read it, a really good reply there. You want to have a look at that as well. We could actually email you that if you haven't seen it. But I would sign up for that on the 4th of December because he's going to explain the horrific dangers of COP9 and COP8. Right, I'm back on the 15th of January to talk about IR35, which is a passion of mine. And can I just say, I think that a lot of the big engagers, huge groups and companies, when they engage Fred or Bob the Builder Limited, they're applying IR35 when they shouldn't be. And in that webinar on the 15th of January, which I encourage you to sign up with for, we're going to tell you how you can fight back and when IR35 will not be applicable. So that's going to be a very practical webinar. It's a passion. I've followed IR35 since the year 2000. That was a song by Busted, wasn't it? In the year 2000, maybe not quite, but it's a passion of mine. I'm writing an article on it at the moment, and I really feel that is well worth watching. We've got a VAT webinar on the 5th of February on commercial property. A lot of advice there. Opting to tax, the 5% rate of VAT, all of that will be covered, and the planning opportunities as well. And the last one that we've got booked in on our website so far is also going to be quite useful, I think, to many clients and accountants. Tax planning for the owner-managed business on the 20th of February next year. It'll soon come round. It'll soon be Valentine's Day next year. Shortly after Valentine's Day, 20th of February, tax planning for the owner-managed business. Right, I hope today has proved useful for you. I'm sure it has, and I'm sure there's things that you can contact us at Gravita about when you sit down and think of some of the issues we covered. We'd love to hear from you. Thank you for attending, and enjoy the rest of your day. Bye-bye.